Keith, so the first question here is, considering where sentiment is currently tracking in bonds and Hedgeye seeing growth slowing in Q1 2017, do you see a possible buy here in bonds for a quick bounce, or would you rather wait on the bounce to reshort in 2017?
I think that's a really good question. I mean, in particular, because I didn't show the data, but Josephine, if you can show the CFTC futures and options data, the client is absolutely right in pointing out that there's a big sentiment indicator. Again, one sentiment indicator. We don't just work off of this, but when you, never mind 2 standard deviations oversold versus itself, that's a 3 standard deviation move. So massive move. What that means is that people are short Treasuries. They're also short, which I highlighted there, the U.S. stock market, which got them plowed last week. Consensus can be right for a little while. It can be right for a long while. Or it can be completely backwards, which people on being long U.S. equity beta was last week. But 10-year Treasury bonds, like a 250,000 net short position in the 10-year bond yield, yeah, the discussion starts to start, okay? The discussion starts to start. So this week's data is really important. And that's, for me, I need a couple things. I need to buy bonds for a trade, okay? This is not a trend, it's for a trade. Because again, you don't get the growth slowing data that you asked about until April, or end of the quarter, March type April. So there's a long time between now and Trump's coronation in April. So that's point number 1, is the timing. Point number 2 is the range. So again, even for a trade, I trade anything at the top end of the range. It doesn't matter what my economic or my research view is. The research view actually doesn't matter in that regard. But if we get up to 2, let's say we get up to 2.55%, we're at the top end of the range, and we get some economic data that slows, now that would be interesting. We've only had data accelerate since Trump, really since the election. This is a bit of a zoom in here, but this is my prep work for the week. But Wednesday, you get November PPI. Thursday, you get CPI. Those are not going to be reasons to short bonds. Those are going to be, or to buy bonds. Those are going to be bearish for bonds, because those will be inflation hawkish data points. The more interesting ones will be retail sales in November, because we had a hot October number. So the probability of that slowing sequentially is actually up a little bit. And then you got industrial production growth, which has been just a depression or a recession, or both, depends on where you live. If you're in a depression, you definitely voted for Trump. If you're in a recession, you did too. So in those states, we've talked about that. That's a really interesting number. So again, net, what did you think my answer was going to be? That I'm data dependent? Bingo. Do I use the range? Yes. Does timing matter in between the bearish growth catalysts when you don't yet have bearish growth data? Yes. If we get bearish growth data, will that give us some kind of a reason if the 10-year bond yield's at the right level? Yes.